this kind of strategy is not for everybody. I mean, we're mainly talking about like buying like new build townhouses. And I would describe buying a new build townhouse as almost like investing into an index fund.
Welcome to Checks and Balances, brought to you by Lighthouse Financial. I'm Michael Vincent. That's James Blair. And today, why you should buy a negatively geared investment property.
We're back in your life. And today, Michael, we're talking about let's buy an asset that makes us lose money?
Yeah, negatively geared properties. The term is thrown around a lot, a little bit of property finance jargon there, and we're going to break down what it is, what it means, and why it's not such a bad thing for property investors. However, James, as we know, there's always winners and losers. So who wins and who loses?
Well, I think the bank wins because you're always paying the interest on the mortgage, which is the negatively geared bit.
The bank always wins. I'm not going to lie.
Yeah. So negatively geared, pretty much every investment property at a 7% interest rate, unless you've had it for a really long time and have no mortgage, is negatively geared. If you had a mortgage and you were at like a 3% interest rate in 2020, 2021, it was probably positively geared.
Yeah.
Let's though talk about, Mike, what does negatively geared mean?
Cool. Negatively geared is a fancy way of saying on a weekly, monthly, fortnightly basis, this property loses money. So the costs associated with that property, the cost of the mortgage or the interest cost on the mortgage, the rates, the insurance, the property management fees, you sum all of that up, and let's say that's $1,000 a week, and you're only getting $700 a week in rent coming in, that is a negatively geared property by $300 a week.
Yeah, and then if you do that over a whole year, that's about 15 grand. And I'd say that'd probably be pretty like consistent with what I see at the moment with where interest rates are.
Yeah.
I guess in terms of like a property being negatively geared and costing you more money, one thing I do see a lot of people stuff up with this is they just go rent less mortgage, positive or negatively geared.
Yeah.
But we forget about all those other costs, right?
Oh, yeah.
Because they're not things that come out every week or every fortnight. The rates is quarterly. Oh, the rates, Michael. The insurance keeps going up. The accountants want to be paid. And the maintenance on the property as well. And we sometimes forget about those things in the calc.
I think maintenance is a big one. The other ones you can kind of sum up on a weekly, fortnightly, monthly basis, like your property management fees, like your rates. Maintenance and unexpected maintenance, those ones will hit you. And they do just come, we've had instances where James and I have an investment property together and we installed brand new toilets as part of the renovations, and 2 weeks later that thing was blocked, and then 2 weeks after that it was blocked again. So there are things that will pop up over time that you are liable for as a landlord, and you got to pay.
Do we want to talk about the blocked toilet story? No? We're moving on? Okay, we're moving on. We're definitely not talking about the blocked toilets. If you want to know about the blocked toilets, put the comments, and I will definitely talk about the blocked toilets.
Just put a poo emoji in the box.
No. I tell you what, there was some bizarre conversations. Okay, so the question is, Mike, so that's what negatively is. It's something that's costing us money. The question is, why on earth would you do this?
Yeah, look, so what you're thinking about there is you're taking a short-term loss on a weekly, monthly, fortnightly basis or regular basis for a long-term capital gain, right? And this is where the power of leverage with property really helps. So effectively, if I said, okay, James, on average, it's costing you about 15 grand a year, right? So let's say you're saying, Mike, I've bought this asset. You're paying 15 grand a year in costs on this property over and above the income that's coming in, right? And let's say $800,000 property and you're getting a 5% annual return per year. That's a $40,000 return. Now, James, if I said to you, Jimmy, you give me 15 grand, I'll give you 40 grand back. Would you take that deal?
I'd say Michael Vincent is back out of prison and he's back scamming people. Do not do that. But the thing about it all is it's really just the power of leverage. Like if you're thinking about it, and the way we try to encourage people to do it is they have a home with some equity and you're borrowing all of the money to buy this investment property. So you're using equity that you're not utilizing for anything else, and you're using the bank's money to buy an asset, and you get to keep all of the capital gain. That is the value right there.
Yeah. So again, negatively gearing, fancy way of saying you're losing money in the short term, but you're gaining over the long term because you use that power of leverage, which we talk a lot about on this podcast. Now, there are always winners and losers in every situation. So James, who would be some of the winners in this situation with negatively geared properties?
This kind of strategy is not for everybody. I mean, we're mainly talking about like buying like new build townhouses. And I would describe buying a new build townhouse as almost like investing into an index fund.
Yeah.
So you're buying an asset, you're not adding any value to it, you're not trying to trade it, it's just tracking whatever the market is doing, right? So slowly, as the house prices go up, this will go up in value. So that is great for the person who is time poor, who isn't going to do anything else, and they're holding an asset for the long term. This is not for the kind of person who loves a little renovation, loves a little admin on the weekend, and doesn't just like doing those sort of things. One has the skill, has the execution, but the big one that we talk to our clients about is time.
Yeah.
So if you're between like, a lot of our clients between like 30 and 50 time poor young kids, you're just not going to have time to go and you might use it to kind of get away from the kids for a little bit, but to get away and do these renovations. So 100%, I want to be really clear. You will make more money buying a property, adding value to it, and getting the rents up and all those sort of things. And a lot of people go, well, I want to do that because I want to make more money. But the big thing is a lot of people won't do that because they don't have the time or the money to do it, which is why a negatively geared property makes sense for them.
Yeah. So negatively geared properties, the big winners here are landlords and people who have the capital and the income to sustain a negatively geared property over the long term, right? And that isn't everyone. So the big losers in these situations, a lot of the times it's first home buyers, because that kind of price point that people are going for say the new build townhouses, a lot of that price point would otherwise be taken up by first home buyers who need that entry level into the market, right?
Do you think, because that's definitely what the comment section will say, do you think those investors are taking house like at that kind of price level, $800,000 house, are taking houses away from first home buyers?
Once upon a time, I think they were. I think there's enough stock on the market at the moment where actually there's enough to go around for everyone in that kind of new build price bracket, 700, 800, 850 around there. That won't always be the case. That stock will get cleared out of the market. Interest rates will come down. I'm not saying we will see runaway prices like we did in 2021, but the market will tick back up again and we will start to see a bit of a shortage. And we can see that already. And we've talked to Matt Horncastle about this around not just building consents, but the number of houses being built versus the population growth and what type of pressure that puts on the housing market. We'll put a link to that in the show notes. Go check it out. Matt has some fascinating thoughts on the housing market and what's actually going to happen.
So the population growth is one I want to talk about, right? Because then it becomes into the question of what city do I buy in? And a lot of people go, I want to buy near me so I can drive past it, I can look at it, I can mow the lawns, whatever. And you can see them a little bit, whatever. The big thing right here is going, okay, if we're buying something that's going to cost us money with the hope that it increases in value over time, we need to be investing in a city that is going to grow over time. If the city's not going to grow, house prices are not going to grow anywhere near as much. So we're talking in cities with high population density. So Auckland, Wellington, Christchurch, major cities. And you also want to be investing into places where, when it comes to employment, that it's not tied to one industry. Really good example is Invercargill. So Invercargill, the smelter and dairy farming. If milk prices are down and if the smelter doesn't have certainty, it's going to 100% impact house prices.
Yeah, 100%. There's one other misconception that I want to clear up around negatively geared properties in New Zealand. And that is because we hear a lot of news out of Australia around people offsetting their negatively geared losses against their personal income tax. Now, this is an Australian kind of thing that you can do. In New Zealand, we have something that's called ring fencing, where you can't take those losses and apply it to, say, your PAYE income like you can in Australia. So that's a really important thing to understand. I know our accountants get asked about it a lot, so it is a misconception we do need to touch on.
Cool. So Mike touched on it a little bit, but let's run through an example in a bit more detail on what the numbers look like for a negatively geared investment property. So let's say you buy a house for $750,000 and you're renting it out for $680 a week. $35,000 a year. Your mortgage at 5.5%, if it's 100% leverage, is $41,000. Your rates, insurance, accounting, let's assume $6,000 a year. The property manager. Now, a lot of people go, I'm going to save some money not having a property manager. Bad idea. It's going to cause you a lot of pain. Just pay the 8.5%. In this scenario, that's $3,500 a year. Plus, Mike, we have to assume for vacancy, because while it would be nice that the property is rented all the time, let's assume 3 weeks a year, $2,000. Now, I did have a client recently say to me, I want to have a higher assumption for vacancy. Like they had the property vacant for 9 weeks or something.
Yeah.
And I was just like, look, you can't, vacancies can happen in bigger, all in one point and be more concentrated, but 3 weeks
On
long
average,
term is fine. So all our costs combined for that property is $52,790, which when you take into account the rent means we're going backwards $17,000 a year. A property worth $750,000, increasing 5% a year, that is going up $37,500. So just coming back to what Mike spoke about before, in a scenario where I give you $17,000 and you give me back 37, I'm pretty happy with that outcome.
Yeah, I'd make that trade all day long.
And a big part of it, Mike, is if you look at the average Kiwi and those who have built really big businesses, those that have got ahead have had investment property.
100%. Where negative gearing can get you into trouble is when you combine over leverage with negative gearing, right? Let's say you get an interest rate spike and maybe you've got 3 houses and you're negatively geared $200 a week on each of them. Yep, $600 a week, you can handle that. But that interest rate doubles and all of a sudden you're negative $1,200 a week or somewhere around there. That's a huge impact to someone's cash flow and it could put pressure on the household. And people go, oh, well, I'll just sell, However, what you don't take into account is that when that happens, things don't happen in isolation. The market's usually down. You have to sell for a loss. So that's where people get tripped up and that's where they get into trouble with these sorts of things. So negatively gearing, not a bad thing. But like always, you've got to make sure you can afford the investments that you're getting into if something goes wrong.
And we found out in 2021, as interest rates started to go up, there's people who did over leverage and got themselves into a lot of pain because they ran all their numbers on 2% interest rates and certainly not 7%. Which does bring me to a question for you, Mike. So interest rates have come from 7 down to about 5.5.
Yep.
When people are running their numbers, what interest rate should they be using to make sure they're okay in any situation?
Yeah, so I would use an 8% interest rate. And that is probably the top you're ever going to hit if you've got a good broker. Because you should, if your broker's good, be able to manage some of that interest rate spike by fixing long term. There are negatives that you can't sell, break costs, et cetera, But I would say if you can do it on 7.5%, 8%, you're probably all right.
Okay. And the other question I've got for you, which I'm sure will be in the comments, is, well, you're assuming house prices are going to continue to increase 5% a year.
I am.
Why do you think house prices will continue to increase at 5% a year?
Because 3% of that is just inflation. 2% of that you can attribute to other factors, population growth, long-term averages. 5% is a pretty conservative number.
And if incomes aren't increasing at the same rate, people go, well, debt to income ratios will just get more and more out of whack over time. What do you think?
Yeah, they might get more and more out of whack over time. However, I have confidence in the New Zealand kind of government and Reserve Bank and banking system that they will put profits over people and those DTIs will be relaxed and the prices will just keep going up.
Yeah. So I think negatively geared properties, I've definitely spoken to quite a few customers who are just like, I don't even know why I bother with this. And what I've been saying to them is, if you mark your success over a 3-year period, you've lost.
Yeah.
But if you invest into an asset which is good over the long term and will get an average, the only thing you need to wait for is time, and time fixes bad investments in the short term.
100%. So James, if someone's listening to this and they're going, negatively geared property, okay, doesn't sound too bad now. Maybe I want to dip my toes in the water. What should they do?
Yeah, so there's heaps of other videos on investment property, on checks and balances. Make sure to go and check those out. If you're going from an education perspective to that, then you're like, I want to have a chat. My boy Michael, he is a mortgage broker. You can have a chat and work out what you can borrow, or go to the Lighthouse website, click talking to our property team. They can talk you through some options, get some more information, and you can make a decision from there.
Sounds good.
Great. All right. Well, much love to Lighthouse for sponsoring this episode. Please make sure to subscribe to the channel. Please make sure to give us a review, give us a like, and we'll catch you next time.
Cheers.